You've watched it happen. Your stop sat exactly where the book said to put it, and price reached down, took it to the pip, and reversed without you. It felt personal, like the market was hunting you. It wasn't. In this masterclass, you'll see how liquidity, market structure, and change of character drive these moves inside smart money concepts, and ICT, and why the market isn't hunting you, it's hunting orders. Read that, and the setups that stopped you out start working for you. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's start with the first one, sweep liquidity. But before you can trade it, you need to understand what liquidity really means. In simple terms, liquidity is just orders in the market, money moving through the system. Price moves because of those orders. When buying pressure increases, price rises. When selling pressure increases, price falls. Now, large moves rarely start in the middle of a range. Why? Because very few orders sit there. Most of them rest above swing highs and below swing lows, where sellers park their stop losses above the highs and buyers park theirs below the lows. So when price reaches those areas, it runs straight into a large pool of orders, and that is what so often triggers a sharp reversal. In other words, liquidity is simply orders clustered around key highs and lows. Once you can see that, you can see where price is most likely to react. Pay close attention here, because this is where most traders misunderstand liquidity. In reality, there are 3 simple ways to identify liquidity, without overcomplicating your charts: equal highs and equal lows, trend liquidity, and range liquidity. But here is the reality. The easiest and most reliable liquidity to identify is equal highs and equal lows. If you are just beginning, this should be your main focus. This forms the foundation of smart liquidity trading. Always remember, markets move because of orders. Our task is straightforward. Identify where the majority of orders are located. When equal highs appear, that represents resistance. When equal lows appear, that represents support. Basic trading education then teaches traders to place stop losses above resistance and below support, which means liquidity naturally accumulates above equal highs and below equal lows. Breakout traders add even more fuel by placing buy stops above the highs and sell stops below the lows, building thick pools of liquidity. This is exactly where many beginners make a mistake. They try to sell directly at equal highs. However, the market often pushes higher first, sweeps that liquidity, and only afterward makes the real move. Many traders call this a stop-loss hunt, but in reality, it is simply the market searching for orders. Institutions, the participants who truly move the market, require large pools of liquidity to enter positions. They cannot enter anywhere they want. So what do? They patiently wait for price to sweep liquidity and only then enter from the opposite side. Now, what should you observe whenever you analyze a chart? If we study this area, we can notice multiple rejections and bounces. Since price respected this level several times, most traders would mark it as a support level. However, this support did not appear randomly. When we zoom out and examine the broader market structure, price was clearly bullish and produced a break of structure, BOS. This tells us that the real origin of this support is the extreme demand zone. When you read pure market structure, the rhythm becomes obvious. A break of structure is followed by a pullback, and once that pullback completes, price tends to deliver another break of structure. That repeating cycle, break, pullback, break, is what builds every trend. Now let's zoom into the liquidity sitting around the extreme demand zone. Notice how several equal lows have formed here. Equal lows always attract liquidity because traders stack their stop losses just beneath them. So the logical play is clear. We place a buy limit right at those equal lows, tuck our stop loss slightly below the demand zone for protection, and set our target on the equal highs above, where another pool of liquidity is already resting. Now watch it unfold. Price dips down, sweeps the equal lows, and triggers our buy limit, then turns sharply higher to collect the liquidity waiting at the equal highs. That one move is market structure, supply and demand, and liquidity working as a single idea. And this is exactly how experienced traders execute. The trader placed that stop below the lows to feel protected, and price walked straight to it. It feels like he was singled out, but the market never knew he existed. It moved there because that is where the orders were. That is personalization bias, reading a mechanical event as a personal one. Now to trendline liquidity, the rule everyone trusts. In this example, we have the British pound against the US dollar. Many traders would connect these two highs and draw a trend line. Their common idea is simple. When price pulls back and touches the trend line, they plan to enter a sell. Others take the opposite approach. They wait for price to break the trend line and then look to buy on the pullback. But here lies the problem. Both approaches often fail. The reason is very simple. They ignore proper market structure. When we step back and read the chart correctly, the market is clearly bearish. We can see two bearish breaks of structure. In a bearish market, the typical sequence is break of structure, pullback, impulse, continuation. This is the core idea behind smart money market structure concepts. That is why relying only on trend lines is not enough. Now, look closely. Price is clearly moving in a downtrend. We have a supply zone, an imbalance, and most importantly, trendline liquidity building above. After several touches, liquidity accumulates above that trend line. So what is price most likely to do? Price will pull back, sweep the trendline liquidity, tap the supply zone, and then continue downward to create another break of structure. That gives us a clear plan. We place a sell limit at the supply zone, set our stop loss above the zone, and target the previous swing low. As price unfolds, the setup plays out perfectly. The target is reached and a new lower low forms. This is how market structure, liquidity, and supply and demand work together. And this is the approach you should be trading with. For the trader who sold that trend line, the break feels like a broken promise. But the line was never a promise, only a place where everyone drew the same orders. Price did not betray the pattern, it collected it. The mistake is treating a shared habit as a private signal. But liquidity does not only appear around supply and demand zones, it also explains something that frustrates many traders. Now, to stop hunting liquidity, the one that feels the most personal. Many traders see their stop losses taken out exactly like this and like this. The frustrating part is that even when they follow the correct strategy and respect all the proper rules, the stop hunt still happens. Let us clarify this. When you get stopped out, banks are not targeting you. The market is simply moving toward liquidity, where orders are concentrated. Here is what most traders do. They sell near the highs and place their stop losses above the high. They buy near the lows and place their stops below the low. What does this create? A pool of buy orders above the highs, a pool of sell orders below the low. As a result, price naturally moves toward these areas to collect orders. That sudden spike that took you out was not manipulation. It was simply the market doing its job. Stop hunts are not personal. They are just liquidity in motion. All right, take a close look at this chart. Price has been rejected and has bounced from this level multiple times. Because of that, many traders naturally draw this area as a support level. Retail traders observe these previous bounces and assume that if price pulls back again, it will bounce once more. Based on that belief, they enter buy positions at support and place their stop losses just below it. However, here is the critical mistake. Since this support level has already been tapped and rejected many times, it actually becomes weaker rather than stronger. It is no longer a fresh or unmitigated level, which means it should not be considered high probability support. Now let us look at the situation from a supply and demand perspective. Instead of focusing on the support line, we identify the candle that appears just before the strong impulse move and mark it as our demand zone. Why does this matter? Because that large bullish candle shows that a significant amount of buying entered the market in that area, very likely institutional participation. There is another important detail to notice. We also have an imbalance in this region. An imbalance simply means that price moved so aggressively that some orders were left unfilled. When this happens, price often returns later to fill those orders. Since this demand zone is still unmitigated, there is a strong probability that price will pull back, fill the imbalance, tap the demand zone, and then continue moving upward. Now look below the support. Because of the repeated taps, equal lows liquidity has formed. Retail traders place their stop losses right below that level. This creates a large pool of liquidity beneath the support. So the plan becomes simple and mechanical. We place a buy limit at the demand zone, our stop loss goes slightly below the zone, and the target is the swing high. As price moves downward, watch what happens. Retail traders get stopped out. Liquidity below support is swept. The imbalance gets filled, and price taps directly into our demand zone, triggering our buy. Then price moves higher and reaches our target. This single setup delivers roughly a 1 to 6 risk-to-reward trade. This one stings the most because the trader stopped out below support often chases the reversal in revenge. It feels like the market took something from him. It did not. It simply traveled to the orders and kept going. Read that wick as information, not an insult. Whenever you analyze the market, the first step is to identify the trend in the market structure. Next, mark the supply and demand zones, along with any imbalances. After that, you will clearly see where liquidity is sitting, and only then can you execute your trades with precision. But liquidity does not only appear around obvious highs and lows. Sometimes the market also creates traps for traders. Now to inducement liquidity, the trap you walk into willingly. What is inducement, and how can it help you win more and lose less? Let us break it down. Before we move to live charts, you need to understand this concept clearly. Inducement occurs when the market draws traders to the wrong side in order to collect liquidity before the real move begins. Once you understand this, you avoid many unnecessary losses. You begin to identify higher probability trades. You stop reacting emotionally to price inducement, and you start trading smarter, not harder. What you're seeing here is a textbook example of how inducement shows up in the market. Price is in a clear downtrend, and we've marked 2 supply zones. Most traders lock on to the first supply zone right away, planning to sell the moment price taps it. On the surface, that looks correct. That's where you'd expect sell orders to be waiting. But this is exactly where the trap springs. Very often, that first zone is only inducement, a level built to pull early sellers in before price pushes higher into the real supply zone, and only then rolls over into the intended bearish move. Traders write this off as an unlucky loss, but there's a clear mechanism behind it. Once you understand how it works, you can stop being caught by it and start trading it in your favor. So how do we know whether a zone is the real deal or just inducement? It comes down to 2 things: liquidity and imbalance. In this example, imagine that an imbalance exists between the 2 supply zones. This means there is open price space that the market has not yet filled. If price had already returned to fill this imbalance, the first supply zone would likely act as a much stronger selling area. But because the imbalance is still open, the market often pushes higher to fill that space. This is exactly where inducement tends to form. Inducement becomes even clearer when liquidity is nearby. For instance, if equal highs form near this level, it suggests that stop losses are likely resting above it. And remember, liquidity simply represents clusters of stop loss orders. So if most traders are selling from that first zone, price will often move higher first to sweep those stops, reach the real supply zone, and then begin the bearish move. These are the 2 main ways to identify inducement: an unfilled imbalance and nearby liquidity. In the next section, I will show you real chart examples so you can recognize this setup in live market conditions. Here we have a 15-minute chart example of inducement in action. As you can see, the market is forming consistent lower highs, and we have just seen a break of structure confirming a new downtrend. Most traders will immediately look at this area and mark it as a supply zone to sell from when price returns. But here is the catch. This is a single movement, and there are also multiple imbalances within this move that may lead price toward the higher supply. Because of that, these lower zones actually act as inducement, not the true reaction point. To help you understand this better, I will zoom out on the chart again and explain it more clearly. Notice that movement number 1 is an impulsive move to the downside. Then we have movement number 2, which is a bullish retracement. After that, movement number 3 is another impulsive move to the downside, with a break of structure. It is this last movement, number 3, whose retracement we are now analyzing. You should never try to buy in a downtrend or attempt to predict a reversal. That is one of the worst mistakes a trader can make. So based on inducement logic, we do not expect a strong reaction from the zones below. Instead, the higher supply becomes the real area of interest. Why? Because although the lower supply attracts sellers, we also have equal high liquidity and unfilled imbalances pulling price upward. More importantly, when we look further to the left, there is no remaining imbalance above the higher supply, which strengthens it as the true selling point. Notice the clue. The lower supply zones have already been retested, but the higher supply has not. That is a key sign. So how do we trade this? The clean approach is to enter from the true supply zone, place the stop loss above the highs, and target the lows, since the market is still in a downtrend. And as price played out, that is exactly what happened. Traders call this an unlucky loss, but nothing unlucky happened. The first zone did not lie to you. It advertised orders, and you answered before the real move. The market cannot deceive someone it never noticed. It only follows liquidity from one pool to the next. Seen that way, the trap becomes a map. You can also use a confirmation-based entry. If you cannot decide which zone to choose, here is a simple trick. Drop your time frame from the 15-minute down to the 5-minute. On the 15-minute chart, you might see 2 separate supply zones. However, if the 5-minute structure still appears bullish, you need to be cautious. Notice how price completely ignores the first zone and breaks straight through it. That happens because the internal structure was still moving upward. The key is to wait for the structure to shift. We only look for a sell entry once price officially turns bearish. Watch as price begins to pull back. When price breaks the recent 5-minute swing low, we call this a change of character. This acts as confirmation that the trend has shifted from bullish to bearish. Because price shifted with strong bearish momentum, it left behind a fresh 5-minute supply zone. This is where we take action. Place a sell limit order directly at that 5-minute supply zone. To stay protected, set your stop loss just above the higher 15-minute supply zone. For your take profit, aim for the recent 15-minute swing low. Notice how cleanly price respects the new bearish structure. It taps our zone and then moves directly toward the target. Trace it back through all 4: sweep, trend line, stop hunt, inducement. None of it was aimed at you. The market has no memory of your position. It only moves toward orders. Read the structure, not the feeling. And the moves that once took you out become the ones you trade. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.